Investors are puzzled. Oil prices are up. Global tensions are high. Yet gold and silver remain stagnant. Historically, these conditions have triggered rallies in precious metals, the classic safe havens. But as of May 31, 2026, gold and silver are stuck, defying decades of market behavior. Why? The answer lies in a clash of economic forces. Inflation and geopolitical risk are pushing metals up, but a stronger force is holding them back: central bank policy, especially from the US Federal Reserve. Understanding this dynamic is key to solving the mystery of underperforming gold and silver. In this analysis, we'll break down how rising oil prices fuel inflation, how central banks respond, and why interest rates are now the main headwind for precious metals. We'll also explore why today's geopolitical risks haven't sparked a flight to safety. By dissecting these factors, we'll clarify what needs to change for gold and silver to finally break out. Let's dive in. Oil prices impact far more than just your gas bill. They ripple through the entire economy. When crude rises, transportation and manufacturing costs soar, pushing up prices for everything from bread to electronics. This is classic cost-push inflation. Higher production costs mean higher prices for consumers. In 2026, sustained high oil acts like a tax, eroding the value of major currencies. Normally, this is when gold and silver shine as inflation hedges. But inflation creates a dilemma for central banks, whose job is to keep prices stable. Their main tool? Raising interest rates. This response, meant to fight inflation, creates new challenges for financial markets. The result, the usual link between inflation and rising gold prices, is broken. The cure for inflation, higher rates, is proving toxic for precious metals. That's the missing piece of the puzzle. Central banks fight inflation by raising interest rates, making borrowing more expensive and slowing the economy. But higher rates also boost yields on government bonds, offering investors a safe, predictable return. Gold, by contrast, pays no interest or dividends. When bonds offer high yields, the opportunity cost of holding gold rises. Investors ask, why hold gold when bonds pay 5% risk-free? As money flows into bonds, gold demand weakens, capping its price. Silver faces the same challenge. In this environment, gold and bonds directly compete for capital. The Fed's aggressive rate hikes have made bonds the preferred safe haven, sidelining precious metals. Until rates fall, gold and silver will struggle to rally. Geopolitical turmoil has always driven investors to gold. Wars, trade disruptions, and instability usually spark a rush to safe havens. Yet in 2026, despite global conflicts, gold prices remain muted. Why? High interest rates overshadow geopolitical fears. For fund managers, the certainty of bond yields outweighs the possibility of crisis. Only a truly systemic threat, like a conflict disrupting the global financial system, would tip the scales. For now, regional conflicts aren't enough. High rates keep gold in check. The precious metals market is a tug-of-war. On one side, inflation and geopolitical risk, both bullish for gold and silver. On the other, high interest rates, offering risk-free returns on bonds. Right now, rates are winning. Central banks are committed to keeping rates high to tame inflation. Investors prefer guaranteed bond yields over gold's potential gains. Even when gold rallies on bad news, high rates pull it back down. For gold and silver to break out, either inflation and risk must intensify, or rates must fall. Until then, metals will likely remain range-bound. The balance of power must shift. What could spark a gold and silver rally? The clearest trigger is a shift in central bank policy. If the Fed signals rate cuts, bonds become less attractive and gold's appeal rises. This could happen if inflation drops or if the economy weakens sharply. A severe geopolitical crisis could also drive investors to gold, overwhelming the appeal of bond yields. For now, high rates are the main obstacle. The fundamental case for precious metals remains strong, but patience is required. Watch for Fed signals, inflation data, and economic reports. A policy pivot is the likely catalyst for the next bull market in gold and silver. Until then, the tug-of-war continues.